Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. It is Monday, March 2nd, and we're looking at how war in the Middle East is creating uncertainty for the stock market. Pretty dramatic things over the weekend, ongoing now, and we had some interesting sort of price action as we're going to be discussing. A lot of the things that we've been talking about remain in effect. We've been talking about the price range on the S&P 500 remained exactly as we've discussed for weeks now, that 6,800 level continuing to hold. And there's some other developments kind of having this week of potentially different price action this week versus what we've seen in the last few weeks. I'm going to kind of get into that. Um, Great. So also I will say that it was great to see one at Masterclass last week. These are the standardized returns of some of the ETFs we're going to be talking about. We had our master class, and at the time I said this market is, aggressively neutral, or the most neutral thing I've ever seen, and I stand by that. The market overall right now, in my opinion, is the most neutral I've ever seen it. I mean, there's times when it's bearish or something else, or trending one way, but we are sitting and we remain in this range on the S&P here, which, the level it really matters, you see it on the weekly here, is 6,800 up to maybe 7,000 or maybe 96, 69, 66. And I say that one because that's the record weekly close. And I continue to, believe that when we close at a new record weekly close, like you see back here, see when we close at that level, you see that kind of continuation. So closing at a new weekly record is really the key thing, I think, in a lot of ways. And you can see here, this level goes back to the beginning of January. So this is a very tight range, really less than 200 points. And so today we slammed down and held it. And that was kind of the sort of thing that, is consistent with what we've been talking about. So I'd say overall right now that we have, well, first of all, go to tradestation.com and then go to Insights, Market Insights. And then you can see we have a blog post with stocks enter, stocks face major uncertainty as war erupts. Some of the points we're going to be talking about are covered in here. So I would just say overall, as we look at the overall market right now, I think that we have an extreme balance between potentially good and potentially bad. So I would say that, jump over quickly to the daily chart of the S&P here. If we look, we can see that the 6,800 level is holding support, and that's a positive. Basically down here around 6,800, we've been holding that level to varying extents for a while here. And when you continue to hold support, that's a positive. The other thing is that sentiment has gotten extremely negative. If you actually look at our article here, go down here, we actually have a part where we mention this, that the sentiment got pretty much relatively on the overall pendulum of swinging between positive and negative. Last week's sentiment got pretty negative, and that also kind of is often a contrary signal. We look very closely at the American Association of Individual Investors, the American Association of Active Investment Managers. Both of those have a weekly kind of sentiment gauge that we always check, and both of them last week got to the lowest level in several months. So that also tells you that money was on the sidelines, and so then when you slam down to support, it's not a surprise to see us come off the bottom of that support. So we've been talking about 6,800, and once again, it did play out. Now, it's interesting on the daily chart is we have an outside candle. I've I have less interest in candlesticks these days. I found them to be less useful than they once were. But especially when you're in a range like this, it doesn't mean a huge amount when things move tightly and then one thing outstrips another. So it's a potential signal. But what stands out to me more, I want to point out, is on Friday we gapped down, and today we tried and failed to get above it. That might be the bigger signal. We also now are, kind of more clearly, you know, getting under that 50-day. The 50-day moving average, we couldn't even get back to it. We're basically stuck under the 10-day simple moving average. So a lot of these indicators are kind of pointing now more to the downside. I think it's, these are starting to show some potential. We have this kind of rounded top to a certain extent. We have also on the weekly chart, we have a lower high. So after the NVIDIA report, I'm sorry, this is the day before NVIDIA, it gapped up. And then basically they sold NVIDIA, and that might turn into a lower high. So overall, I think we guys look at this and realize here that this is maybe trying to tell us some stuff here. And I think it's also important to realize that the situation in the Middle East, I think, should not be overthought. And I would almost say, if anything, that it could be a kind of heads I win, tails you lose. And, if I think right now the most important thing is that the market doesn't expect anything horribly bad to come of the situation in the Middle East. It assumes it will essentially go away. So that creates two risks. One risk is that it doesn't go away. and it results in a prolonged period of higher oil costs, which would be almost certainly a negative for the S&P. But secondly, it creates a risk that then we go back to the reasons why people were bearish last week. We go back to the reason why things were negative last week. And that's the thing I want to get to, is that we actually do have some other negatives out here. When you look, we basically have on Friday, PPI was much higher than people expected, the core PPI. And now today, we look at the Institute for Supply Management, the manufacturing index showed an insanely high price reading. So we now have inflation risks kind of accelerating again in the eyes of the market. I think that's really important here. So we're in a situation where, say, the Iran thing goes away, and all right, fine, hunky dory. Now we go back to looking at the stock market. Well, what do we see? We basically see inflationary risk. The other thing that's interesting is that there was an article last week from FactSet that said analysts are actually lowering their earnings estimates for the first time in 3 quarters. So maybe we've read the spot now when everyone's saying double-digit earnings growth, blah blah blah, all this great stuff looking into the future. But what happens if we've actually reached peak positivity on earnings growth? So I think that's another thing to kind of bear in mind here. So that's just, these are the two kind of forces that I'm putting out there and just kind of trying to weigh and tell you that on one hand there's there are reasons to be positive, holding sentiment, holding support, having a lot of negative sentiment. Those things can be positive. And you take a step back, there are negatives of inflation and stalling earnings growth. And also last week it was interesting, UBS and Bank of America both kind of put out these notes saying they continue to expect American equities to underperform global. Main thing is things like loss of things like the dollar and overvaluation and high valuations and things like that. But I think it's important to realize, look at the S&P here overall. All these moving averages are on top of each other, and that often does kind of tell you that the trend is, if we stay under them but close to them at a certain point in time, it does create the potential for this overall intermediate momentum to turn bearish. And I'm not saying that's what happens, because I do think it's interesting to look at things like Nvidia earnings and think they were strong. But I think overall right now we're in a situation when the Fed. I got look at this the CME. Let's look at this. This is the CME Fed watch. Look what happened in June. This is the June meeting. The June meeting was supposed to be our first rate cut. So a week ago, we were basically at more than a 50% chance of a rate cut, either the 45 and then also that 8, because that was the 2 cuts. So we were basically a 50% chance, more than 50% chance last week, a week ago, that we were going to have a rate cut in June. Now we're at 55% no cut. This might be the main story. Just want to point that out. All right, so all right, last week was lower high. So basically, um, I think overall, we also have to realize that we might have a little bit of situation here where I'm looking at, like, what might happen with something like the dollar, potential for that to, have, some squeeze the upside. I'm not really sure right now about anything with currency. I want to just point out that I think right now the Fed is really the thing that's kind of standing up more. And then the other thing is, last week we had some other negatives, like we highlight in this article. Obviously, I mean, as I was kind of researching, there were things that kind of had I hadn't noticed. Like, apparently, Moody said that there's this whole thing of hyperscalers having 662 billion of off-balance sheet lease commitments. CoreWeave had this issue thing of, again, what do we see? Weak guidance and aggressive capital spending. So capital spending and debt. That's what people are seeing. They're seeing capital spending, they're seeing debt, and they're not necessarily seeing terrific earnings growth. And then on top of that, we do have this whole situation overall of a lot of private credit and a lot of private equity that is built up in the last 10 to 15 years, and there's various metrics showing that it's not doing terrifically well. And then at the same time, if you put on top of that no rate cuts, it does create other kinds of risks. So I just want to point those things out. I mean, I think to a certain extent, we're looking at small cracks that are not necessarily fatal, and we shouldn't overstate them, but nonetheless, these are just some of the forces that are now building. And what's also interesting is today we see Nvidia getting to work again. I'm going to hide this. This is what the other thing here is: the advanced decline lines been hitting new highs all along, showing strong breadth. This is not necessarily a bullish for the market. One of the things I think is interesting here is we want to see, and I was saying last week, we could be at the beginning of the Nasdaq finally stepping up and coming back to life, and that I think is actually the main thing to think about here. Could we get into a spot where basically the Nasdaq, after a long period of lagging, as we had said, broke this trend line, and now the question is, does it now hold that broken trend line and rally off? We mentioned a false breakdown here, some bullish outside days. We have another bullish outside day here. So now the real question is, can we get back above that pre-NVIDIA high, above the 50-day moving average, and can we turn this into something which will then turn into, a new uptrend, a new extension to the upside? There are ingredients here in place for this to happen. Now the question is, will the dollar show up, and will it actually turn into a breakout, or will this basically confirm the double top here that we saw, and then will we actually see it? And we see a breakback under, kind of 600, 595 here on the Qs. This could be something that does turn into more worrisome. So I think it's important to kind of realize it's interesting. We see some of the cracks in the credit situation, things like the earnings growth potentially having peaked, the inability of Nvidia to really rally significantly after its earnings. Here, NVDA. Look at this here. I'm going to hide my advanced decline line. Remember, the advanced decline line doing well is not necessarily great for the S&P. We've seen this before, basically, when your leader stocks falter, and then basically a bunch of random stocks like consumer staples and utilities do well, and they create this breadth that, while it looks positive, might not be. So I think it's, the advanced decline line overall I would not make too much of. Now, NVIDIA, here we are. I think we just have to see that we just stay in this range. We were talking about this range for a long time, and we're still in it. NVIDIA, essentially here, I think it's just a spot where people are just going to continue to kind of see which way it goes. And I think when you look at the market overall, not surprisingly, the biggest company is also in a range, just like the S&P. So I think we just have to realize here is that we are in a range, and we are trying to figure out what comes next. Do the scary things subside? Can we go back and focus on the fact that we still have strong earnings growth and there's still some positives? Or do we actually look out and we see that, you know, things have maybe gotten as good as they're going to get? And as we look forward, earnings growth starts to weaken, Fed cuts start to become less likely. And then we actually could be in a situation where people say, wow, valuations are pretty high. And if we're not going to get earnings growth, and we're not going to get rate cuts, maybe that's not so great for for risk and for overall equities as well. But it is interesting that Nvidia today bought I think $2 billion each in coherent COHRs. Fiber optics. Now, we talked a lot about fiber optics on our webinars, and fiber optics, here's another one, COHR, and Lumentum, I think, Lite. So that's interesting, but I want to point out a few other things. This is a crazy, sort of volatile, speculative name, but AAOI, this is another leveraged, you know, shorted, volatile fiber optic stock, but they reported earnings and they might be kind of squeezing here. I mean, the stock's up significantly, as you can see. But if we get into a spot here of a kind of short squeeze in fiber optics, this is something that people might want to put on their radar. Another one I think is interesting is that Ciena reports earnings on Thursday, CIEN. We've talked about fiber optics a bunch, so I wanted to put these on your list. Another one that I'm watching is Fabrinet, FN, fiber optic stock, rallied, pulled back, and basically look is trying to hold around here. I'm watching it around this kind of 530 level, and so I want to kind of point that one out. Now, also overall in tech, it's interesting to see Lam Research is basically, chip equipment company trying to kind of hold these weekly lows here, basically down around like 230. And then another one that was interesting, we had talked about ALB, the lithium company, and it had this huge surge after we mentioned it, and it's right back where it started. This might be also something people want to kind of look at, ALB. And then also XYZ, which is Block, the old Square run by Jack Dorsey. They cut like 40% of their workforce. They're going to do big cuts, use AI to save costs and all things like that. But this stock has had a significant long-term downturn, a significant long-term sort of decline. And, it's just kind of interesting to see, is this maybe something now where people look for this to, be the beginning of a whole new cycle in a name like XYZ? Now, remember, this stock, when the old days of being Square, was a very popular growth stock back in these periods, back in the late last decade, and then in COVID. So I think it's important to realize that this is a company that has a strong history, and there is a history of people liking it. And if they manage to turn things around, this is a name that might get on people's radar. And then just a few very quickly, industrials I want to very quickly mention is Deere had a strong earnings report, pulling back and kind of holding that gap up. Caterpillar basically been one of the strongest names. They have the data center thing happening, and here you also have them moving across. And we are in a period here where industrials are incredibly strong. And I think it's interesting just to realize that Caterpillar is one of the leading names. And if you look at how it's holding right here, it's 21-day exponential moving average. This is, I think, also a name people might see an opportunity in. Alcoa is also one we were talking about. Talking this to some of the people at the end of masterclass, as this chart essentially look at this kind of this basing pattern on Alcoa AA, which I think is also would my drawing tool go for this? My curve. Here we go, curve, and you can just see. I mean, essentially here, I think it's very interesting. Sort of pulled back, held, trying to make higher lows, AA, and then those are the main like individual stocks we'll talk about. I'm also going to quickly look here at Nucor. What is interesting, Nucor is a steel maker, NUE and STLD, Steel Dynamics. When you look at the report from the Institute for Supply Management, why were prices high? It was aluminum and steel. So tariffs and whatever else continue to kind of support these areas. So I wanted to kind of mention that. So now let's just quickly look now at the overall index. Like I said, extremely neutral sideways here and holding 6,800. So in my view here, we remain in this range. And as they say, the longer the base, the higher the space. If the market does want to break out from here, when it escapes from this level, people might look for it to have a healthy run. So I think at this point in time, it's coming off. If it's coming off the lows and it is pushing higher here, the question simply becomes: does it actually start to get up to the levels that matter? And like I said, the weekly closing high of 69.66 from early January, I think, is still a kind of key area people are going to be focused on. Now, the situation in the Middle East could very well be a near-term catalyst for individual price movements. So you should be aware of that. It's also interesting if you look on the daily chart, there was this really important close from October 29th all the way back here, and we're just kind of back to it again. It's basically 68.91. It just remains this level that we closed at, and you can see at various times how this level essentially has been like this key support and resistance at different points in time. So it's interesting to see that we're back stalling at it again. The charts remember these levels. They go back and back. You can see there. All right, so that was the S&P. The Qs here. I have said that I think that one of the big risks in this market is that we do simply see a giant return to normal. And I would say, imagine, for example, the situation in the Middle East resolves quickly. Not a lot of damage is done. We could be in a spot where the dollar regains its global strength, where this whole thing of selling America and all this other stuff that we saw last year, that could reverse. And we could be in a situation where people go back to what we did before, which was buy treasuries, buy the dollar, buy US stocks, buy NASDAQ. That could happen. And we could be in a spot where all the people looking for gold and silver to outperform, looking for global to outperform, end up basically stuck in a trade that doesn't last. So I think we just have to realize here is that there's still growth overall in large cap growth stocks, and this is still an area that has a history of doing well. And here, as we look at it, we've broken that trend line. And from my perspective here, coming off the bottom of this range, I wouldn't even necessarily put a whole lot of credence in. I mean, that level that I just removed around kind of 610, I think 611, it is something of a near-term level. But I mean, again, we talked about last week. We talked about how there were positive signs developing in the Nasdaq, and basically, this chart does seem to continue to confirm those patterns. Now, the Dow last week we talked about the level at kind of 48,448, the low from the first full week of the year. That's exactly where it bottomed today. So these levels, we talk about them, so it's worth kind of watching them. And I think right here, this is and also a noteworthy thing. Now, at this moment in time, if we actually do, like I just said, and we turn back to a kind of tech market, a growth market, that would be kind of not so great for the Dow. It would mean more of a sort of growth market and not a value market. We've had basically a 6 to 9 month value bull market, but that might go away. And so I think right here to realize the Dow holding this level is a positive overall for the broader market, but it also might be something where if we do see a strong rally in the Nasdaq and in tech, this might just remain range bound, and then all the strength go into tech. So just realize that. Now the Russell here also very tight range, and I think this is one that if we do get into a strong large cap rally, historically this has stalled. So let's just see what happens. I think from this point, people might look for this to break out of the range and extend higher. That might be in the cards this time because it's supposed to have strong earnings growth this year in the small caps. So I think right now, watching to see if we can close above the level of the week that began January 12th, which is around 2678. A weekly close above that level could see some extension here in the Russell. But also, this macro environment in the Russell is not super fabulous of having like less rate cuts and things like that. So that's the Russell, RUT. Now, the 10-year Treasury yield, TNX, basically, coming off the lows, we had kind of, you know, mentioned how this was something that had this strange rally in treasuries, in prices, and this decline in yields. And from my view here, this is something now where this also could support the Qs because if the yields do move higher, historically that's actually been good for the Qs. It's been bad for value, been bad for small caps, been good for large cap growth. So I think this here is just like not a super relevant trade right now in terms of the bonds themselves. But I think it's interesting to see if they do kind of work their way back up to 4.25. XLB materials, um, you know, this remains in a very tight consolidation. This is a very underowned, very small sector. And, given what we're seeing with the inflation price things and things like that, um, I think right now this might be something where people look at this and they see this as something that has broken out and it's maybe not done yet. So I think right here the key thing about this is that it's extremely tight after breaking out, and it's also a relatively new breakout, which means that at this point in time, there might still be the ability of new capital to enter into the materials XLB. If that happens, I would add it could actually trigger a breakout in the Russell because I've noticed that the Russell's had a decent correlation with the materials. So I think just realize we could see something here where, like I say for example, people decide, you know what, America's not so bad after all. Let's buy US stocks. Let's get out of this whole gold thing and this whole emerging market global thing. And we go back to the US. Then, something like there's a small number of material stocks. It's not big in market cap. So a little bit of money going into them could potentially do something. Same thing with the Russell. These are small buckets that could potentially have a big impact from the marginal dollars going in. Now, XLC Communications, we talked last week about how this was actually setting up. And I think right now, people might want to see here of communications of all the sectors or the large cap growth sectors, this could be the one that has the most potential for a breakout now. We have clarity on everything with Netflix and Paramount and all that stuff. This whole merger bidding war has been going on, but we also have had some very interesting price action in things like Google and Alphabet holding this level here from mid-December at kind of 297. And so I think right now, also you look at Meta overall. I mean, the chart is just kind of holding, but the fact is that at this point in time, Meta is not breaking lower, and I think we're in a spot here where, I'm watching potentially to see if communications lead us or kind of lead the Nasdaq on a breakout just quietly out of nowhere. Because honestly, they've been so tight, it might not take much before you know it, they're hitting new highs and people start chasing. So XLE Energy is obviously completely connected to the situation in the Middle East. The one thing I'll say is that it's not clear the fundamentals are that good in energy. Last week we had very significant inventory builds of crude oil. There's a lot of geopolitical risk now priced into this, and if that situation goes away, I think we got to realize here is that energy, after like how many, I mean, like multiple like weeks to the upside, this could enter a period of consolidation. So I think you have to realize here is that this has a lot of good news priced in, and there's risk that it basically um, ends up in a good direction, or that the geopolitical situation improves, and this ends up in a spot when it needs to basically take a pause. So financials, we had basically noted the potential of this to bleed lower, and that's exactly what happened. The XLF, from my view here, this is kind of like a wounded animal. I think that even if we have you know, the overall market breaking out. These guys might be in a spot when, yeah, there are some credit losses, there are some issues out there. It doesn't mean that the overall market's going to crash. There's going to be contagion. It might just be that there are some things that are blemished that are not so great. Someone has to basically take those hits. And when you look what's happening in private equity, when you look at things like that, and you consider, whoa, what if there's no rate cuts? What if June is no rate cut? You put those things together, and basically maybe financials here have to be in the penalty box, and they have to basically be the one to take the pain for now, as other parts of the market kind of do well. And I think it's important to realize now is that these different things are things like credit losses, private equity. A lot of these things are being talked about when you look at stocks like what was it? It was Apollo, Blue Owl. I mean, pullbacks like this don't just immediately go away. I mean, this could be something that lingers and weighs on the financials for a while. And so I think right now that these are in an area where people might simply look for this to bleed across and maybe even go back and test some levels even under 50, and just kind of suck wind for a while. Now, industrials, on the other hand, are fascinating because they are just not backing down. And I think right here, this is something where very mild pullbacks are where people are going to want to be active in this. Last week, it's interesting to see how we basically held the lows of the week. The pullback was extremely minor inside week. Now we're having a new high. This is kind of breaking out of a short-term period of consolidation. That's why I also noticed earlier, here's a daily chart of the XLI. And that's why I think people might look to a name like Caterpillar, which has been one of the big leaders. I do think that's an important one to focus on. XLK, going back now to the weekly, the XLK, this is very similar to the Qs, basically holding the bottom of this range. And so from my view here, it's interesting to see if we kind of don't really make it to the bottom of the range, have some false breakdowns here under the level from the February 9th week. And I think right here, this is something where it's sloppy, but it's not broken. And it's going from, a clear sort of downtrend kind of to neutrality. And neutrality can be sloppy, but the fact is that it's not cleanly bearish anymore. Maybe, that's a potential. And they look at also things like software. These guys have actually gone down. Look at the software, the IGV here. It's basically gone down and held a level. So, I mean, the fact is software might be in a spot when it struggles for a while. I think overall, I mean, I look at the overall situation in technology, and I know that I've been able to develop stuff that I couldn't develop before. It does seem like the industry is disrupted in various ways. It doesn't mean the whole industry goes away, obviously. But I mean, from my view, I think this is something where people looking at things like software might think that its long-term run is maybe done for a while. That doesn't mean though that it might not have a degree of rebound. And that could also be something that if that takes shape, that could also be something that brings us back up on the broader market. That is XLK. XLP, consumer staples. Now this was very strong, and it helped to kind of trigger the overall, move higher. From here, people may look for this simply to consolidate. A big part of this story is Walmart, which has had an interesting pullback here. From my view here, people might want to look for the next kind of leg down in Walmart. It might need to do more like an A, B, C, and maybe get kind of down more toward 120. So from my view here, people looking for something like Walmart might look for another push to the downside, and something like XLP in that case might have to consolidate here and chop back down its range a bit. So from my view here, this is something here XLP has had a pretty significant run for a sector that's usually pretty boring, and people might actually look now for this to have more of a period of consolidation. But if XLP was to go red, that would not be a bearish thing for the S&P. That would actually be likely a positive. XLRE real estate, these have gone up and they kind of found this new high. I think, again, if we do have more upside in yields, this thing might be kind of finished for a while. So from my view, these are still in a spot where, I think that there's no clear opportunity maybe in these. People probably are going to be more interested in seeing, a little more confidence of the Fed cutting rates. The same thing goes to a certain extent for utilities here. They this week, they're stuck below their high from last week. They're closed from last week. And when you have something like this, which is also not a very dramatic sector, and you see it basically enter what could be a period of consolidation, people might look for this to move its way back down the range, back under 46 in the XLU. utilities. XLV Healthcare. Now, we talked about the potential for this to break out, and honestly, last week it did close at a record weekly closing high. Now, from my view, this is actually giving a potential here. This signal we've looked at, when you close at the record high, you look for a few days of weakness followed by a breakout to new highs. So, from my view here, this is potentially giving us a signal that suggests that healthcare could be actually in a spot where it's ready to take a move, to make more of a move to the sustained run after consolidating here. So, I think healthcare might be one that also kind of comes out of nowhere. So, financial struggle, but industrials and healthcare maybe step up and do some work. But consumer staples here are also kind of in this, this drifting penalty box. And I think overall, this is also one that at this point in time, it's kind of drifting here. There is some potential here for this level around 114, but I think the main thing with this is it Tesla. You know, is supposed to have robo taxis next month if they successfully get them going. And there are some people saying that they're having some real issues with the safety. But if they manage to actually get those the robo taxis working, then that could actually be something. But remember, that's supposed to be in April. So I think that's really the key driver here for the consumer discretionary is going to be what happens with Tesla. So I hope everyone has a great day. Um, and we will be back. We'll be back on Monday. We might do another webinar before that. I'm still kind of looking at the market and trying to figure out all these conflicting forces going on. Hope everyone has a great day, and we'll see you again soon. Thank you very much.